Stablecoins are an incredibly exciting topic, and there's a lot happening. So much so that it can be difficult to understand really what's happening, both in the immediate moment as well as where this is all headed for banks, for fintechs, for wallets, for merchants, for you and me. To understand where we're headed with stablecoins, I spoke with Chuk Okpalugo. Chuk is a former banker, investor. He is a product strategist. He's worked in many parts of the financial and fintech worlds, and he has a lot of experience in stablecoins and integrating them into enterprises. There are many use cases evolving for stablecoins, but our conversation centered on correspondent banking because that's where the action is now. And we looked at what this means for banks, particularly banks that are able to successfully adapt to this new technology, as well as to fintechs and card providers and other players in this world. This conversation helped me get a good sense of what's going on, and I think it'll help you get a really good sense of where this is going and what the real opportunity is and can be. My name is Jame DiBiasio, and this is my report. Chuk Okpalugo, welcome to the JDB Report.
Thanks for having me.
My pleasure. I've seen your postings and your work on LinkedIn and social media, and I thought this is somebody who I'd really like to talk to because you have an interesting background. Your career has seems to have lined up for you to be heavily involved in the stablecoin industry evolution. You've got a background in investment banking and in private equity, investing in tech. You've worked at a variety of fintechs. You've worked at Paxos, which I think was probably what really catapulted you into this space, doing a lot of stablecoin integration work there. And now you are on your own, or with doing a new thing, which includes
Hmm.
a lot of public speaking and writing. So thanks for your time.
Appreciate it.
Um, Stablecoins are a very uh, urgent topic with whether you're in banking or you're in crypto or you're in fintech or payments, and you have been working towards ideas around business models that you see emerging. Some of them, I guess, will be more successful than others. So I'd like to get a sense of where you see business models headed. Are they all converging in a very similar way, or are we going to see a huge disparity and a lot of variety in the way that different operators in this space, institutions, fintechs, crypto, payments, etc., how they will create businesses that are going to be viable, make money, and also serve a real need? So maybe you could give us a quick broad overlay of what you see happening,
Oh,
and then we'll get into some of the nitty-gritty.
yeah, that's a great question, and it makes sense to kind of start at a very high level. There are several layers to this onion, and I think at the very center of it are stablecoin issuers, the companies that create the actual token. They manage reserves, and the biggest of which is Tether. The second biggest of which is Circle. When people think about stablecoin business models, the first thought is the issuer, and as it should be. There are many layers around that. And so there's the infrastructure around utilizing that token. Like, what are you using that token for? The core use case has been for a very long time trading. So the exchanges facilitate trading on crypto exchanges. Think of Binance, Kraken, Coinbase. And the stablecoin there is a much more efficient way to move dollars around. Fiat in general, but dollars is the dominant one. And so that's a secondary use case, but stablecoins are a core part of how that works. And then as we keep moving further to various other layers of the onion, you start getting into other use cases such as payments, treasury, settlement, and then the ability to hold balance anywhere because you can hold a balance in a wallet, and that wallet can be, put into an application, an existing application, a new application, and so now from the initial nucleus of having a stable coin that allows you to hold a dollar anywhere around, anywhere in the world, move it 24/7, you now have a lot of other business models that are built on this technology. And as you stitch together, different exchanges, some of them are on chain, you've got different decentralized lending protocols, you've got centralized services that can be accessed, and you can use this common substrate, this dollar that moves around 24/7 as a way to interconnect them all. You can start to build very interesting applications. And I think hopefully that I'm hinting there that anything that is kind of connected to this ecosystem starts to be impacted in terms of their business model from the very initial layer of the stablecoin issuers themselves, the providers of infrastructure that facilitate payments, the providers of infrastructure that facilitate these applications that can then use stablecoins for their advantage. So across the entire stack of the payments, banking, or call it neo-banking,
Mhm.
uh, trading, and many other business models, and we can talk about card issuance, for example,
Right.
stablecoins impact essentially the unit economics of running that business, particularly if it involves some global flows. And therefore, in terms of business models, outside of the specific stablecoin issuers themselves, you have a lot of potential benefits and advantages wherever you fall up in that stack.
All right. I want to drill down in a couple of use cases and understand how it changes the game for incumbents as well
Mhm.
as the opportunities for new players. But first, I have another a general question. You talked about how stablecoins were originally this trading vehicle within crypto, and now are being adapted for other uses. How suitable are we finding it in terms of that adaptation? Because they weren't built for cross-border payments, for example. They weren't built as a treasury tool. So, are these things being adapted well? Is it a very seamless leap into let's say, a TradFi function, or does it require quite a lot of integration and rethinking?
Yes, I think at a high level, I would say that payment rails generally, if you think about ACH
Mhm.
in the US and other payment systems, whether they're instant or not, and other geos, they are essentially a set of rules that folks who are part of that payment system agree on in terms of how to manage risk and liability. And so it doesn't necessarily make them good for all use cases. And therefore, you have intermediaries, financial payment processors, and others suit those tools, those payment layers to the use case. So I think the same can be said about stablecoin. It's really just kind of this underlying layer. The magic in it is that we've attached something in the real world, these dollars in an account that are invested in treasuries, to a mechanism that keeps the peg, and now that value is treated as a dollar on chain. Now, what you do with that depends on how you connect that to your existing systems. So, for example, payment acceptance. Let's talk about you having stablecoins in your wallet and you want to go pay for something at a merchant. If that merchant does not accept stablecoins, you have a problem.
Right.
Now, it's like if you have cash and they have cash, they can take cash from you and they recognize it. And if it's the currency that they are used to, great. But if you are in, let's just say you are in Brazil and you give the merchant euros, but the euros are still money. But the merchant doesn't accept euros, and now the merchant has to go figure out what to do with that. And so, in the same way that there's not always perfect compatibility between different payment systems, you then have uh, companies who provide that layer so that the Brazilian merchant can accept stablecoins, and the Brazilian merchant themselves don't really need to deal with conversion and integration. They just receive Brazilian real or dollars or stablecoins in their account should they choose. And so that's one example of merchant acceptance where, just like in traditional payments, there are facilitators, payment processors, and other types of infrastructure that make all of the heavy lifting possible.
And that heavy lifting and all those intermediaries, what do they do to the story around stablecoins are super cheap and super fast? So yeah,
Yes.
at final settlement, yes, obviously it's almost instant, but there's then these different layers. FX could be another one, and maybe some hidden corners where people are able to charge a little bit more. So, what are, in practical terms, are stablecoins? Let's say if we're talking about a cross-border payment,
Mhm.
are stablecoins living up to the hype of being faster and cheaper at the end of that road?
Sure. So two answers: yes and no. And it's yes because um, we have to explain the how cross-border payments work end to end, because a cross-border payment is not really a single thing. The cross-border payment is the outcome. One user decided that they have capital in one area and they want to debit their account in one country so that another person's account in a different country gets credited, the cross-border payment. For that to happen today, whether that be through your bank and the correspondent banking system, through Wise and their orchestration of the correspondent banking system, or through a stablecoin powered infrastructure, or through a stablecoin itself, there are many steps, and there always will be many steps until a day where person A has the same asset on the same ledger as person B. So that's why I say yes and no, because if someone says, "Oh, can I compare this very, very direct method from over here where Wise has positioned payments from both sides and it's essentially instant with a stablecoin that is also essentially instant." So, well, it kind of looks the same. What's different is the plumbing.
Mhm.
And so the where the yes comes in is if you were to, me and you today were to say, okay, we're gonna set up a cross-border payment company between Brazil and Hong Kong. With the capital required to set with the correspondent banking system is substantial because we have to position funds in both places in order
Refunding.
to manage the flows,
Right.
right? The pre-funding, right?
Yeah.
And with stablecoins, essentially, you are able to deliver value to a counterparty who already is positioned in that country. And so the capital required for me to fund the payout of a cross-border payment is much less. That means more companies can start cross-border payment companies, more companies can tackle more complex corridors, and the capital efficiency of the infrastructure underlying uh, cross-border payments is greater. So that's why I answer the question with yes and no, because if you really abstract the question, you have to answer it with that's not how payments work.
Yeah.
But when you get into it, it's actually yes, stablecoins make cross-border payment treasury more efficient. Okay, is that cheaper? Well, technically, yes, because the capital cost of funding the pre-funding was actually being amortized across all the payments that the company was making. So technically, yes.
Right.
But they were fronting you that money anyway, and they were very competitive, and they were making money elsewhere. So it may not necessarily be on like a apples to apples or one to one, but when you take into account the cost of running the business, it does. And when you take into account, for example, when you're pre-funding in different currencies, and you have the risk and potentially FX losses, that's another cost you have to bake into the business of running cross-border. So if you can remove the amount of pre-funding, you remove the FX risk, and you remove another source of drags on your capital efficiency. So I would say stablecoins make cross-border payments cross-border payment companies more efficient, and therefore it makes cross-border payments cheaper. Now, another thing I would say is that was a very kind of like plumbing based on this
Right.
explanation.
Love the plumbing.
The real yeah, that's where the magic happens, right?
Exactly.
The short answer is yes. If you take a corridor that's not well served by the existing MTOs,
Mhm.
then yes, stablecoins are cheaper, definitely faster,
Yeah.
and often cheaper. But the cost a lot of the time is FX. And if there are certain countries where demand for dollars is so great due to either capital controls or other things that there's a premium on the currency on getting stablecoins. So if you use stablecoins as a way to get dollars into the country, you can often beat the, let's say, the mid-market rate, interbank rate. Oftentimes there isn't an interbank rate because the actual interbank rate is driven by an authority that has capital controls and it's not going to write FX of supply and demand,
Right.
right? And so, yes, in certain cases, it's cheaper. In other cases, it's faster, flat. But I think those are all point, taking this particular corridor, taking this particular situation.
Right.
I think more generally, it's more capital efficient. And therefore, it's cheaper from a capital efficiency perspective. And then whether it's faster or cheaper for a particular corridor is corridor dependent.
What do you see happening in terms of correspondent banking? Is it uh, is this a Clayton Christianson style dilemma of the innovators? Where the incumbents, face sort of something that they don't see coming because it's irrelevant to them. They allow this businesses that they're not interested in, and then suddenly, before they know it, they've got a giant competitor. Or can they really power through because, at the end of the day, they control the dominant corridors, and that's what matters.
Yes. I think it's going to be very, very interesting to see over the next 10 years. I feel strongly that the correspondent banking system will see the most change or the most impact
Mhm.
of stablecoins. And that is for this very reason of there was no other solution for holding another country's currency, or there was no other kind of well-connected network solution. And what I mean by that, for those who are not familiar with correspondent banking, a very simplified version is if you are to accept cross-border payments, if you accept other currencies, you need a place to hold those currencies. If you're a bank in Brazil and you need to hold dollars, the dollar system is in the US, and so you typically need to partner with a US bank an account. So just like we have money at our bank, banks have money at other banks. And that system is a bit of a network, a bit of a spider's web, where you have a couple of correspondent banks in the middle, and then lots of other regional banks connect to them. And oftentimes there's another bank connected to that. And so what what is being solved here is the ability to hold liquidity. And that is fundamentally changing. What I mean by that is, if you today, typically, if you have one bank, one person in one country sending money to another person in another country, those banks update their balances on each other's balance sheet. And it's because the receiving bank country needs to have an account that has dollars.
Right.
Mm, And with stablecoins, or any kind of digital asset, but let's just say stablecoins because they're the most liquid today, that bank can now hold the dollars directly. Now this is just a very new kind of quite profound shift. And it's not going to happen overnight because these assets today are private liabilities of private companies. Genius is making this much more regulated and much more safe. There's still many a risk committee to figure this out. But folks are starting to partner to figure out how to do this. But we'll take an example of the cross-border payments, and I think this is the one that is the most kind of prescient. Um, when you are a cross-border payment company that has already, many customers, many flows, today you need to fund in our example, to pre-fund your payout provider in country B, you need to use the SWIFT system, i.e., the correspondent banking system, to move money into their account. And if they have a dollar account at a dollar institution, then you can move dollars into that institution. And if they don't, then you have to move it through somebody who will handle the effects. And so the amount of time it takes for you to send value to that, so that whose account of the payout provider has an account at that bank. Right? So you need to send your money to this person, and they have an account at this bank. That takes a long time. The banks are closed on the weekends. The banks are closed after certain hours. When you're doing cross border and different time zones, there's lots of cutoffs you have to deal with. Now, it would be much simpler if you could just send stablecoins directly to that bank. And yes, there's compliance things that need to be solved here because banks know they onboard each other in this correspondent banking system. There's a lot of controls required to make sure that they can communicate who the payment is for, what's the purpose, they run the compliance checks, and this is often why the money gets slowed down because people are running these checks or systems are running these checks. But if you can skip many of the hops related in that chain that I mentioned of country A, one bank going to the correspondent of country A, this has a correspondent in country B to the final receiving bank of country B, and just send the stablecoin directly to the receiving bank in country B, you just skipped uh, all the compliance checks in the middle, and you only need the compliance check at the very end.
Right.
So that is the fundamental difference. That you could just shift the liquidity to places where it's needed, and in that model, the receiving bank needs to be able to do something with that stablecoin. And that's the thing that is, there's still a lot of work to be done there. They either need to then ramp that to a fiat account, a dollar fiat account. So again, we're back in the correspondent banking system, right? Or they need to have demand for that stablecoin so that their customers who are making payouts in the direction can utilize that and take it off their hands. Or, you can imagine over time an ecosystem of, market makers and traders who help banks with this liquidity. But in general, you then turn this kind of complex web into a slightly less, well, but actually more complex web, but there's more connections. Because as long as two banks agree to onboard each other, then they are able to kind of deliver balances directly to each other rather than having to go through what is really a very kind of limited set of
Yeah.
routes.
But
But
they're
it's a very
also,
big change.
yeah, because you're also moving from managing money moving between accounts and seeing the world through the lens of I have an account with you with a balance and I will net that for you versus basically a bearer instrument, which may or may not also have a yield or some other funky capacity capability attached to it. So you're basically moving assets rather than accounts. And so, do you have a sense of if this is something that banks are getting their heads around? Do they see an advantage in this? Because we're sort of turning their traditional correspondent banking infrastructure into a kind of a capital market.
Yes. So there are many firms who are working with banks to help them manage this accounting, this core integration. There's two things, and you mentioned them both here. There's the fundamentals of how this is different and what it is and what's the liability, what's the asset. Then there's accounting for it in their systems with all the controls that they have under the regulations they have. Um, First is a kind of education and time problem. The second one is a technical one, and it's a very challenging one because you are going to a situation where now, it's not like you can always just roll back or you have full control of your core often, depending on
Right.
who your core provider is. Now you're saying, hey, this is an asset that is bearer, and if you mess it up, it's gone. Now, the amount of controls you can imagine a regulated bank must have in order to manage that is much higher. But this industry has been around now for, over a decade at this point. There are many enterprise grade, bank grade wallet providers, wallet infrastructure providers. There are more and more compliance tooling, core bank integration companies that are designed to help banks with this problem. And so we are in the very, very early innings of a world where, particularly, again, there's a lot of places that this can go, but it just focus on the what's right in front of us, which is cross-border payments, particularly for receiving countries, particularly in countries where there's a demand for the dollar. Right now, it's going through fintechs, OTC providers, and a lot of other kind of more capital markets companies who are quicker to move and less regulated. I think the end game is well actually kind of back to your Clayton Christensen point. Um, the banks have a right to win here because they are already the kind of custodian of these funds and these accounts, but they will need to update. They'll need to accept, and this is not issuing a stablecoin. It's really the ability to receive it on behalf of your customers, credit their account so they can make a local payout. And again, handling the demand for doing payouts or working with an OTC provider or another regulated market maker to manage your liquidity. I think that is the opportunity in cross-border payments for banks from a correspondent banking.
Okay, that's very clear. Let's wrap up with where else you see the business models evolving. So we've talked about banks not as issuers, but as acceptances and liquidity managers. Uh, Very quickly, if you look at issuers, exchanges, fintechs, cards, and anybody else I'm missing. Obviously, there's the broad sort of neo-banking vendor community, but let's leave that aside. But the major players in the markets itself, uh, how close are they to developing models that are going to be, sustainable and lucrative? Are they going to be commoditized, or are they finding meaningful, durable revenue sources with a lovely moat?
Sure. I guess I would say the when you bring it out to that level, then kind of the fundamentals of most kind of still holds. Who can acquire the things that are to acquire. Sometimes those things are licenses. Increasingly, that's not necessarily the case. And relationships that are hard won and built up over time with increasing amounts of trust always going to be hard to gain. And so there are certain infrastructure providers that these hard to get relationships to get trust levels where they're enabled to do product features that others cannot, that have a moat because they don't have competition who can do the exact same thing. However, I think if you think about it as a barbell, where on one side you have the applications, on the other side you have the metal, then in some cases, yes, the metal has moats where either, as I just mentioned, it's harder for others kind of to get those licenses or to have those banking relationships, but not always. In many markets, licenses are actually not as hard to get. It'll take you 6 to 12 months, but you can get it. The banking providers or the banking as a service providers are open for business. Okay, then that market is not. It's no longer a moat to have a license. So let's shift to the other side of the barbell, which is the application layer. And then it's a tale as old as time. Can you win the end user in a business where you can keep them through stickiness because you can attach 2, 3, 4 different products for them. There's a lot of companies that are starting to look like banks. Maybe they started as marketplaces or vertical or SaaS companies or gig economy platforms. I really think that this is one of the biggest opportunities out of the what's typically called the stablecoin ecosystem. It's embedded finance. Now that will come as like an old term for many of the fintech nerds who are listening.
Yeah.
But the premise is the same. You own your customer, you're providing them services. Some of those are financial workflows where they trust you and not create a more sticky and a UX than their local bank or their alternative because they're spending so much time with you or they're actually receiving money through you, given the marketplace or the payroll kind of example. And typically that's been quite hard to do, and it's really been driven by the wave of banking as a service providers that we've seen in the 2010s and so on. Most of them have been local, or call it regional, really strong players in the US, like Unit, for example. And you can look at each country and there's typically a leading banking as a service or embedded finance player. Now with stablecoins, you're enabling folks to hold balances globally. It's still tricky to manage compliance globally, but you're getting more and more AI-driven compliance firms who help you do global compliance. And then you can start to stitch together a way to have global yield-bearing assets. So therefore now you've got, a savings account equivalent on a global scale. And then you have global card issuers who you can issue a card on your stablecoin balance. And so when you stitch all that together, what you've essentially got is an embedded finance product that works at a global scale. And so with that, there's often better. Think of 3.5% with a card that gets you 1 to 2% rewards. You can do global payouts for not very much money, built into a platform that you already spend time with, and they have a modern interface. Oh, by the way, and your agent can talk to it now. And that's going to be the basic standard. And so the threat is really the markets where banks are competing for consumers and consumers are not as sticky. It's going to be tricky to hold on to those customers.
Yeah.
The
Okay.
markets where their businesses, I think it's a similar thing. It's going to take a bit more time, but people are acquiring these business customers with AI software and workflows, and they're going to embed finance into them as well. And so I think that's actually the opportunity over the next 10.
Chuck, that's amazing. Thank you so much for laying that out for me and for our viewers. Last question. Where can people find you?
Sure. You can find me on LinkedIn, Lugo, or on X, just go XYZ.
Okay. And are you able to share what's coming next in your career?
Hopefully soon. But for now, we'll keep working.
Okay. All right. So you guys can find Chuck on LinkedIn and X. Chuk Okpalugo, thank you so much for joining me on the JDB report.
Thank you for having me.